Chapter 1. The lattice under the market price does not move like a soldier. It moves like weather over a city, sometimes drifting, sometimes returning, sometimes breaking windows without warning. Grid trading is the attempt to build a small city inside that weather, a city made of levels, orders, and patience. Each price line becomes a street, each order becomes a lantern, and the trader waits for the market to wander through the streets and light them one by one. The classic grid is simple in appearance. A trader places buy orders below the current price and sell orders above it, hoping that the market will breathe up and down inside a range. The market falls, the grid buys. The market rises, the grid sells. It is an old merchant's dream. Buy inventory when the crowd is afraid, release it when the crowd becomes confident again. But the directional or asymmetric grid is more dramatic. It does not pretend that the market is perfectly balanced. It says, perhaps the wind is blowing north, so I will build more stairs in that direction. Perhaps the trend is alive, so I will let the grid lean with it. A neutral grid is a chessboard. An asymmetric grid is a chessboard tilted on a hill. This is why the strategy feels romantic and dangerous at the same time. It turns chaos into architecture, but the architecture can collapse if the storm becomes too strong. The trader is not a prophet here. He is closer to a watchmaker building a mechanism inside a thunderstorm. When the mechanism works, it feels elegant. When it fails, it teaches humility faster than any textbook. Chapter 2. Before the grid had a name. Long before trading bots and crypto exchanges, markets already had grids in spirit. Ancient merchants did not speak about algorithms, but they understood shelves, inventories, seasons, and recurring prices. A grain trader might buy after harvest when supply was heavy and sell months later when scarcity returned. The language was different, but the rhythm was familiar. Accumulate lower, distribute higher, survive the waiting. In feudal Japan, rice was more than food. It was status, taxation, salary, and political oxygen. Samurai were often paid in rice, while merchants in Osaka turned rice receipts into instruments that could be traded before the grain itself changed hands. In 1730, the Tokugawa shogunate officially authorized a rice futures market at Dojima, and the market already had clearing functions and membership structures that resemble the skeleton of modern exchanges. Imagine the streets around Dojima: warehouse keepers, brokers, couriers, clerks, and men who could smell panic in the price of rice. They did not have candlestick apps in their pockets, but Japanese rice traders helped develop some of the visual traditions later associated with candlestick charting. A candle on a chart is a tiny historical painting. Open, high, low, close, hope, fear, exhaustion. Every candle says that price has memory. Grid trading was not born in Dojima as a named strategy, but Dojima gave the world something deeper: the idea that future prices could be organized, standardized, watched, and traded. Once prices became a public theater, people began to build systems around them. The grid is one descendant of that theater. It is the rice warehouse translated into numbers. Chapter 3. The Merchant's Instinct. At the heart of grid trading is a merchant's instinct, not a mathematician's fantasy. A shopkeeper understands that inventory bought too expensively becomes a burden, and inventory bought cheaply becomes opportunity. If umbrellas are bought in sunshine and sold in rain, the profit is not magic. It is preparation. Grid trading takes this shopkeeper logic and places it into the market with mechanical discipline. The simplest grid behaves like a calm shopkeeper. It does not shout, chase, or beg the market to move. It sets prices in advance, almost like labels on shelves. Buy here, sell there, buy again lower, sell again higher. The market becomes the customer walking unpredictably through the store. But a financial market is not a normal store. The shelves move, the walls move, the weather changes indoors, and sometimes the customer burns the building down. This is the central contradiction of the grid. It feels like a peaceful commercial system, yet it lives inside an environment that can become violent. The charm of the strategy comes from the promise of order. The danger comes from believing that order is permanent. Directional grid trading appears when the shopkeeper develops an opinion. He no longer stocks everything equally. If he believes winter is coming, he buys more coats than sandals. If he believes demand is rising, he leaves more room for higher prices. In market language, the grid becomes asymmetric: different spacing, different position sizes, different exposure, different tolerance for movement in one direction. Chapter 4. The Market Maker's Shadow. To understand grid trading, one must understand the market maker's shadow. Market makers stand between buyers and sellers, posting bids and offers so that other people can trade more easily. They earn from the spread, but they also carry inventory risk. When too many people sell to them, they become heavy with inventory. When too many people buy from them, they may become short and exposed. A grid trader imitates a tiny private version of this behavior. The trader places resting orders, waits to be filled, and hopes to sell inventory at better prices later. The grid is not identical to professional market making because professional firms use speed, information, capital, hedging, and exchange relationships that ordinary traders do not have. Still, the family resemblance is visible. Both are fascinated by spread, inventory, and mean reversion. There is poetry in the bid-ask spread. It is the small toll gate through which impatience passes. The impatient buyer pays the ask. The impatient seller accepts the bid. The patient provider of liquidity waits between them. In a romantic history of markets, the spread is the narrow bridge where time becomes money. The asymmetric grid borrows another lesson from market makers. Inventory must be managed, not worshipped. A trader leaning long must know how much inventory he can carry if the market keeps falling. A trader leaning short must know what happens if the market rises without mercy. The grid is beautiful only when its inventory is survivable. Chapter 5. The Neutral Grid, a Garden for Sideways Markets. The neutral grid dreams of a market that returns home. It is designed for ranges, channels, and sleepy landscapes where price wanders but does not escape. In such an environment, every fall can become a seed and every rebound can become a harvest. The trader does not need to predict the final destination, only that the path will twist enough to create repeated transactions. This is why neutral grid trading became popular in foreign exchange. Currency pairs often spend long periods oscillating because currencies are relative instruments, one nation's money against another's. Central banks, interest rates, trade flows, and political expectations push and pull, but many pairs can remain trapped in broad ranges for months. To the grid trader, a range looks like a vineyard. The fruit grows only if the seasons repeat. The everyday analogy is a ferry crossing a river. If the ferry keeps moving between two banks, the owner can earn from every crossing. But if the river dries up, there is no business. If the river floods and sweeps the ferry away, there is no business either. Neutral grids need movement, but not too much movement. They need volatility with boundaries. The trap is that sideways markets often look permanent just before they stop being sideways. A range can become a trend without asking permission. The grid, which was happily collecting small gains, can suddenly begin collecting losing inventory. The garden becomes a swamp when the market refuses to come back. Chapter 6. The Directional Grid, when the lattice learns to lean. The directional grid begins with a confession. The trader has a bias. Maybe Bitcoin is in an uptrend. Maybe gold is being accumulated. Maybe a currency is weakening under central bank pressure. Instead of placing perfectly balanced orders in a below price, the trader builds a grid that favors one side. The structure still uses levels, but the soul of the system is no longer neutral. A long directional grid may buy dips more aggressively and sell partial rebounds while keeping a core long exposure. It behaves like a climber who expects the mountain path to rise, but knows the path will not rise in a straight line. Each pullback becomes a place to add. Each rebound becomes a place to lighten or collect. The trader wants the trend, but he wants the trend with rhythm. A short directional grid works in reverse. It may sell rallies in a declining market, then cover portions lower as price falls. This can look elegant on paper, especially in assets that are breaking down slowly. But short exposure has its own dangers, especially in markets where squeezes can be sudden and brutal. A short grid can be trapped by a violent reversal as easily as a long grid can be trapped by a collapse. The word asymmetric matters because the grid can lean in many ways. Levels may be closer below price than above it, or position size may increase in one direction, or take profit distances may vary by regime. The grid is no longer a symmetrical cage. It is a sail adjusted to the wind. The trader's art is deciding whether the wind is real or imagined. Chapter 7. The asymmetric grid and the psychology of bias. An asymmetric grid reveals the trader's belief more honestly than a speech. If the grid buys more aggressively than it sells, the trader is bullish, even if he claims to be neutral. If the grid gives more room to one side, the trader has chosen a story about the market. Every parameter is a confession. Spacing, size, range, leverage, stop level, reset rule. This is where psychology enters. People like asymmetric grids because they feel more intelligent than neutral grids. The trader is not merely collecting volatility, he is adding judgment, narrative, and directional conviction. That can be an advantage when the judgment is disciplined. It can become a disaster when the judgment is only hope wearing a mathematical mask. The greatest enemy is the seductive phrase, "It will come back." In grid trading, this phrase has ruined more accounts than many visible enemies. Sometimes price does come back, and the trader feels like a patient genius. Sometimes it does not, and the grid becomes a machine that converts stubbornness into exposure. A safer philosophy is to treat every asymmetric grid as a thesis with an expiration date. The trader should know what market condition would prove the thesis wrong. Trend filters, volatility limits, capital caps, and stop mechanisms are not decorations. They are the walls of the castle. Without them, the grid is not a strategy but a prayer repeated at fixed intervals. Chapter 8. Donchian, Trends, and the Opposite Religion. Richard Donchian represents a different religion of trading. He became known as a pioneer of systematic trend following, especially through rules that bought breakouts and sold breakdowns. Trend followers do not usually want to buy every dip inside a range. They want to catch the moment when price escapes the range and begins a larger journey. This creates an interesting contrast. The grid trader often loves the range. The trend follower often waits for the range to die. One profits from return, the other from departure. One builds a net, the other builds a sail. Markets need both personalities because markets are sometimes rooms and sometimes roads. The famous turtle trading experiment of the 1980s, associated with Richard Dennis and William Eckhart, helped turn rule-based trading into legend. Dennis believed traders could be trained. Eckhart was more skeptical. The turtles were taught systematic rules, risk sizing, and discipline, and their story became one of the great myths of modern trading culture. It was not grid trading, but it shaped the world in which directional grids later evolved. The asymmetric grid lives between these religions. It says, "I respect the range, but I suspect a trend. I will harvest oscillations, but I will lean toward the larger current." This hybrid personality makes it attractive and dangerous. A trader can easily confuse flexibility with contradiction. Chapter 9. The Forex Nights and the Rise of Robots. The modern grid became famous in the night markets of retail Forex. Foreign exchange trades almost around the clock during the business week, and this gave traders the feeling of an ocean that never sleeps. Platforms like MetaTrader allowed people to build expert advisors, small trading robots that could open, close, repeat, and calculate without fatigue. The grid found its machine body there. In online forums, grid systems acquired a strange mythology. Some traders spoke of them as if they had discovered a quiet money engine. Screenshots of smooth equity curves traveled faster than warnings about drawdown. Many systems worked beautifully in backtests, especially when the tested period was friendly, costs were low, and the market eventually returned to the center. The reality was less magical. A grid robot could earn many small profits and then lose them in one extended move. This is the classic asymmetry. Frequent small wins, rare large losses. The account statement might look like a calm staircase upward until one day a trapdoor appears. The trader learns that the market does not pay interest on denial. Still, the Forex era mattered because it democratized automation. Strategies that once required institutional systems could now be coded by individuals. The grid became a household machine in the world of retail speculation. It was no longer a concept hidden in dealing rooms. It was a downloadable creature living on home computers and VPS servers. Chapter 10. The Swiss franc, when the floor vanished. One of the great cautionary stories for grid-like thinking is the Swiss franc shock of January 15, 2015. For years, the Swiss National Bank had maintained a minimum exchange rate of 1.2 francs per euro. Many market participants treated that level as if it were a stone wall. Then the wall disappeared. When the SNB abandoned the floor, the franc surged violently, and parts of the forex world were thrown into chaos. Brokers suffered, traders faced negative balances, and models that assumed liquid exits discovered that exits can vanish. The lesson was not only about Switzerland. It was about any strategy that quietly depends on the belief that extreme movement will not happen. For a grid trader, the story is almost biblical. The grid loves repeated motion near known levels, but a policy shock can turn known levels into ruins. Orders that looked rational yesterday can become dangerous today. Liquidity can thin, spreads can widen, stops can slip, and the machine can behave like a carriage without horses. This does not mean grid trading is useless. It means the grid must respect event risk, leverage, and regime change. Central bank meetings, pegs, wars, exchange outages, liquidity crises, and surprise announcements are not background noise. They are the gods of the landscape, and the grid is only a small human structure beneath them. Chapter 11. Crypto, the grid, finds a neon city. Crypto gave grid trading a new stage. The market traded day and night. Volatility was abundant, and retail traders were comfortable with bots. Bitcoin, Ethereum, and thousands of smaller tokens created a world where price could move like a fever dream. For grid traders, this neon city looked rich with opportunity. Exchanges and platforms began offering grid bots as built-in tools. Spot grids, futures grids, AI parameter suggestions, copyable bots, and mobile dashboards made the strategy visually seductive. The trader no longer had to code an expert advisor or rent a server. With a few taps, the lattice could be placed over a market that never closed. But crypto also amplified every old danger. Volatility created opportunity, but it also created liquidation. Trends could run farther than expected, tokens could collapse, liquidity could disappear, and exchange-specific risks could matter as much as chart patterns. A grid on a major asset is already risky. A grid on a fragile token can become a trap decorated with bright colors. The directional crypto grid became especially popular because many traders did not want pure neutrality. They believed in the long-term rise of an asset, but wanted to harvest volatility along the way. A long Bitcoin grid, for example, might try to accumulate during pullbacks while taking partial profit on rallies. The story is attractive. Own the future, trade the waves. The discipline is harder than the slogan. Chapter 12. Anatomy of a directional grid. A directional grid has several organs. First comes the price range, the zone where the strategy is allowed to operate. Then comes grid spacing, the distance between levels. Then comes order size, how much capital each level receives. Then comes the directional bias, whether the grid favors accumulation, distribution, trend continuation, or controlled exit. Spacing is not a minor detail. If the spacing is too tight, transaction costs and noise can devour the system. If the spacing is too wide, the grid may sit idle while price dances between levels. Some traders use fixed percentage spacing. Others use volatility measures such as ATR. The purpose is to make the grid breathe with the market rather than suffocate inside it. Position sizing is the moral center of the strategy. A grid can look safe when each order is small and terrifying when sizing increases too aggressively. Martingale-style grids, where position size grows after adverse moves, are especially seductive because they can recover beautifully until they cannot. The danger is not that they always fail. The danger is that they can fail in a way that erases the memory of many previous successes. The asymmetric element can be expressed through size, spacing, exits, or rebalancing. A bullish grid might allocate more capital to lower buy levels while selling only a portion on rebounds. A bearish grid might scale into shorts on rallies and cover in stages. A more cautious version might stop adding after a defined exposure cap. The best grids are less like traps and more like controlled irrigation systems. Chapter 13. The Everyday Metaphor. Stairs, Shops, and Fishing Nets. The easiest metaphor for grid trading is a staircase. In a neutral grid, the trader places steps above and below the current price, expecting price to walk up and down. Each step creates a possible transaction. If price behaves like a restless guest in a hotel, the staircase becomes useful. The directional grid is more like a staircase built on a slope. If the trader believes the mountain rises, he builds the steps to help him climb, but he also expects slips. The point is not to predict every footstep. The point is to create a structure that can benefit from messy movement in the preferred direction. Another metaphor is the fishing net. A neutral grid casts the net evenly in a pond. An asymmetric grid notices the current and weights one side of the net more heavily. That may catch more fish if the current is understood correctly. If the current changes, the same weighting can drag the net underwater. In daily life, people use informal grids all the time. A buyer waits for discounts, buys more when prices fall, and buys less when prices rise. A small business owner stocks inventory gradually rather than all at once. A traveler exchanges currency in stages before a trip. Grid trading takes that familiar behavior and adds automation, leverage, speed, and market risk. Chapter 14. The Comedy of Parameters. There is a quiet comedy in grid trading. Traders often believe the perfect settings are hiding somewhere like buried treasure. 10 levels or 20, arithmetic grid or geometric grid, 1% spacing or 0.5% spacing, fixed size or increasing size. Every parameter feels like a key to the kingdom. Online communities have produced endless debates about these settings. Someone posts a backtest where a grid survives 3 years with majestic smoothness. Another person changes the spread, the commission, the slippage, or the starting date, and the miracle becomes ordinary. A third person adds leverage, and the ordinary becomes fatal. The comedy is that the market often defeats the parameter that looked most scientific. The deeper truth is that settings are not independent from market regime. A grid that works in low volatility consolidation may fail in a high volatility breakout. A crypto grid that works during an accumulation period may suffer during a liquidation cascade. A forex grid that survives a quiet carry environment may break during a central bank surprise. Parameters are not magic numbers. They are agreements with a particular kind of weather. This is why serious grid design begins with scenario thinking. What happens if price trends upward for weeks? What happens if it falls 30% without meaningful rebound? What happens if volatility doubles? What happens if spreads widen or funding costs turn hostile? A grid without scenario testing is like a ship designed only for paintings of the sea. Chapter 15. Risk, the monster beneath the music. The music of grid trading is made of small, closed profits. The monster beneath the music is open risk. A trader may see many completed trades and feel successful, while the unrealized position quietly grows in the background. The account becomes a theater with bright lamps in front and a dark basement underneath. The first risk is trend risk. A market that moves one way for too long can load the grid with inventory or short exposure. The second risk is leverage risk, especially in futures grids where liquidation can arrive before the market has time to return. The third risk is liquidity risk. The price you expect may not be the price you receive. The fourth risk is psychological risk, the temptation to widen the range, add more funds, or remove the stop because the machine almost worked. Asymmetric grids add a fifth risk, narrative attachment. Because the trader has a directional view, he may defend the grid as if defending his identity. He may interpret every adverse move as temporary and every favorable move as proof. Markets punish this kind of romance. They do not care whether the story is beautiful. A disciplined grid must have a final line. That line may be a stop loss, a maximum drawdown, a maximum inventory, a volatility shutdown, a time-based exit, or a trend invalidation rule. The exact form can differ, but the existence of the line is non-negotiable. Without a final line, the grid has no ending, and strategies without endings often end badly. Chapter 16. The Present and the Future of the Grid. Today, grid trading sits at the intersection of retail platforms, algorithmic design, and behavioral finance. It is available on crypto exchanges, discussed in Forex forums, coded in Python notebooks, and wrapped in friendly mobile interfaces. The strategy looks modern because the interface is modern. But underneath, it is still the old merchant question. At what prices should I buy? At what prices should I sell? And how much inventory can I survive holding? The future of directional and asymmetric grids will likely become more adaptive. Static grids may give way to dynamic grids that shift ranges, adjust spacing, reduce exposure in dangerous regimes, and use volatility or trend filters. Machine learning may help classify regimes, but it will not abolish risk. A model can estimate weather. It cannot repeal storms. The best way to understand the grid is not as a money machine, but as a philosophy of structured participation. It accepts that markets move in waves, that perfect timing is rare, and that repeated small decisions can sometimes outperform one dramatic prediction. It also accepts, if designed honestly, that every structure has a breaking point. The grid is not immortal. It is architecture under pressure. So the final image is this. A trader stands before the market at night, drawing horizontal lines across darkness. Each line is a promise, a trap, a hope, and a limit. The neutral grid waits for the market to return. The directional grid leans toward a future it believes is coming. And somewhere between patience and danger, between mathematics and myth, the trader learns the oldest lesson of markets. Price may visit your levels, but it never swears loyalty to them.